So Damian had this tweet the other day. He said, "Hey, Daniel Schreiber and Tim Bixby, I figured out your juicy little secret that with current metrics, Lemonade is making hundreds of percent of internal rate of return on CAC spend by using synthetic agents." Oops, did I say that out loud? Stay tuned, everyone, if you want to see my calculations on this. And we have the pleasure right here, right now, in this video. Damian has actually recorded his calculations, broken this down for us, explained it all for us. And he had done a video before on my channel, which should pop up as a link right about now and also being linked below down in the description, where he explained a lot of these same calculations. But in that video, it was a little bit different. He had different inputs. So in that video, he was using 87% annual dollar retention and the predicted 81% loss ratio from Investor Day, and using those as his main inputs to get the results. But now he's updated some of those inputs, moved it ahead to 85% annual dollar retention and 70% expected lifetime loss ratio. And the results are quite interesting, I must say. So I do warn you, the video we're about to watch is quite technical, but Damian, he's really good explaining things in a straightforward way, and also has a very nice, clear summary table that he's going to break down for us to show us all the summary of results. And again, make sure you watch the end because all the results are quite interesting. And I even think his assumptions around the marketing efficiency could be more on the conservative side. So in my mind, at least for me, I think these results are pretty accurate or even a bit conservative. But like all things on this channel, nothing here is financial advice. Certainly not. Damian wants you to know that as well. Nothing he's saying here is financial advice. And I also want to tell you, big plug for him, Damian, let's get this guy more followers. If you're on Twitter and you're following the Lemonade story, make sure you give him a follow. He posts really, really great stuff and making some great contributions to the Lemonade community. So without further ado, enjoy.
Hello everyone, this is Damian coming to you from Belgium. In today's video, I would like to give you an update on Lemonade's synthetic agent program, which is something they announced 6 months ago, and at the time they wrote a blog post, and I also made a video about it where I went through some equations with regards to their marketing efficiency. So I would highly recommend watching that video first, because today we will also discuss some equations, and it's good to have a basic knowledge about them that you can find in the previous video. Alright, just as a short refresher, the synthetic agent program, what was it about? Well, basically it's a way for Lemonade to get external financing for their customer acquisition costs. In order to grow rapidly, they have to spend a lot in marketing, and the customer acquisition cost is significant. So if they have to pay for it all themselves, all upfront, that gives them some cash flow problems, right? So to solve this, they introduced the synthetic agent program. Now, and in this blog post they gave some numbers. We went through them in their in the previous video. But for today, just a quick refresher. They told us back then that without using any synthetic agents, they were getting a 50% return on their marketing dollars investment, right? Now, with the synthetic agent program, they told us that that could rise, right, up to 90%. Now, in the meantime, since 6 months ago, of course, Lemonade has evolved as a company, and maybe today we can perform these calculations again and see with the updated numbers what does this result in, and what internal rate of return are they getting now on their marketing spend, in the case they are not using the synthetic agent program, and in the case they are using it. Well, in fact, they are using it, and in today's video we will show you why this is the case. What is so beneficial for Lemonade to use the synthetic agent program? And once you've watched this video, I think you will understand why it's beneficial for them, and then you will also understand why recently they announced that this synthetic agent program would be extended and expanded. So you will understand why that's a good idea for Lemonade. I have a table here that we will fill in during this video. Okay, so what does this say? Well, the table will show you that Lemonade synthetic agent program is immensely beneficial, especially when they are using the synthetic agents to the fullest, meaning that they will pay a high percentage of the customer acquisition cost. it's basically up to 80% that the synthetic agent can pay. The more they pay, the more commission they will get from the customers that are acquired through this program. CAC is the customer acquisition cost. PNC is a new term that I coined here, which means the initial annual premium of a new customer. So PNC. And then IRR is the internal rate of return. Basically tells you what kind of profit they are making by spending these marketing dollars and whether it's a good idea to do so or not. 6 months ago, when Lemonade wrote their blog post, their calculations were based on the numbers they had back then for their loss ratio, their annual dollar retention. But today we have updated numbers, right? In the Q3 letter of 2023, Lemonade actually gave us updated numbers, and for the first time ever, they also gave us specific numbers for a specific cohort of customers, namely the customers that joined them 1 year ago. So now for the first time ever, we got from Lemonade numbers on how customers did during their first year at Lemonade, a first year loss ratio. Now this first year loss ratio was around 70%, right? 1 quarter it was higher, 1 quarter it was a bit lower, but we can assume that the loss ratio for new cohorts in the future will be about 70%, right? It's been a year since those customers were acquired, so we can assume that Lemonade systems got a bit better. But also there's a lot of rate hikes that have been approved in the meantime, which would give a positive effect on their loss ratio. So I think it's a fine assumption to make that the loss ratio for new cohorts will be around 70%. That's what we will do today. And we will also assume that this loss ratio is constant, remains constant throughout time. Then for annual dollar retention, unfortunately, we do not have specific numbers for first-year customers. So we'll just have to use their general average annual dollar retention rate for all their customers. And on the one hand, you could say, but new customers are more likely to churn, and that's true, which would lower their annual dollar retention. But on the other hand, new customers are maybe also more likely to be cross-sold or upsold, right? Upsold, I don't know how you say it. Cross-selling and upselling will give a positive effect on annual dollar retention for first-year customers. For example, a customer might start out with a pet policy, and then once their home insurance is up for renewal, they might switch that to Lemonade as well, increasing their premium, so giving a positive effect on annual dollar retention. So we will just assume that the annual dollar retention for new customers is the same as the average, so that's 85%, and we will also assume that to be constant throughout time. Then, when we calculate the IRR in this table, we will also take the time value of money into account, like Lemonade did in their original blog post, except for when we are calculating the internal rate of return of the synthetic agents. All right, so what do we have here in this table? Well, there's 3 columns, and these are 3 different scenarios for their marketing efficiency. Half a year ago, we calculated that their marketing efficiency back then was 300 over 100, which meant that for every $100 they are spending in advertising, they are getting new premiums. They are getting new premiums worth $300. Now, during 2023, they did have slow growth, right? They slowed their growth intentionally, but that also meant that they were actually able to pick low-hanging fruit, right? So the ideal customers. So if they're planning on scaling growth back up, which they are, then we might see that marketing efficiency go down a bit, right? So that's why I have these 2 other columns here, where they are still spending $100 in customer acquisition cost, but they are only getting $250 of premium in return, or maybe $200, right? So most right column is the most optimistic, and then we become a bit more pessimistic when we go to the left. Okay, so let's first calculate how much time would Lemonade need to recuperate their customer acquisition spend if they weren't using the synthetic agent program. Okay, let's have a look at the calculation. Here you can see the calculation. Basically, they are spending $100 in customer acquisition cost. And then what are they getting back? Well, they are getting back 200 of annual premium, so divided by 12 to get a monthly premium. Then the 0.7 here, that's their loss ratio, so what they are still getting after paying out the claim is 1 minus 0.7 times the premium. And then we also here have the annual dollar retention rate, which is turned into a monthly dollar retention rate by this 12 here. And then we are going to perform a sum over months. So this I value will increase each month. So this is basically the sum of the premium that Lemonade is getting from this customer every month, minus the claims they are paying out. Okay, so if we are solving this equation, then we are actually looking for the number of the month X, after which their $100 customer acquisition cost will be paid back. Okay, so let's have a look at what time, at what moment they will have gotten their money back. And it takes them 23 months. Okay, so this is pretty much in line with what they wrote in their blog post half a year ago. They were talking about 24 months thereabouts, but that was actually based on different numbers, right? Back then, the marketing efficiency was this number here, but their loss ratio was higher. So it turns out that now, even with worse marketing efficiency, they would get their money back in 23 months. We can do the same calculation again for these two more optimistic scenarios. So those are these equations here, right? This one, and then also this one. And you can see when we look at the table, when you solve these equations, you get a payback period of 18 months or even less, 15 months. Right? So that's without using any synthetic agent program. Lemonade is getting their money back in between like 15 months and 23 months. Okay, what would be their internal rate of return on this customer acquisition spend if they're not using the synthetic agent program? Well, let's calculate it. That's what we're doing with this equation right here. So what you can see is they are paying again $100 in customer acquisition cost. They are getting in return $200 worth of premium from this new customer. We divide it by 12 to get the monthly premium. Basically, it's the same as before, except now we are actually summing up until infinity. So you might wonder, well, the customer isn't going to live forever, right? So why would he remain a customer forever? Why are we summing up to infinite number of months? Well, basically, it doesn't really matter. This factor here will make sure that the sum converges after a reasonable number of months. So it's okay to sum up to infinity here. In fact, after a number of years, we will have a convergent sum. So that's fine. Then we are also taking the time value of money into account here. Money is losing its value at 4% each year, we are assuming. And then we are solving the equation for this X here, which will be their internal rate of return. Okay, so let's have a look. When we open the table and make it visible, they will be getting a 51% internal rate of return. Again, this is similar to what they wrote in their blog post, even though this is based on different numbers, right? Once again, half a year ago, this was their marketing efficiency and their loss ratio was higher than it is now. So they would be getting a 50% internal rate of return. Now, even for this worse marketing efficiency, they are still getting the same return because now their loss ratio is lower. Okay, let's have a look here. What happens if their marketing efficiency is a bit better? Then we have the same equation, except we are using $250 for the initial premium of a new customer. And I also must clarify that even though I'm assuming here that the customer acquisition cost is $100 and they are getting $250 of premium in return, or annual premium, at least initially, it doesn't really matter what these absolute numbers are, only the ratio is important, okay? So if they are spending $200 to acquire a customer, but they are getting $500 of initial premium, that's basically the same. Okay, this gives the same result for their IRR. Okay, so let's assume $100 customer acquisition spend. That's customer acquisition cost, that's about right. And they are getting, for example, 250 of initial annual premium from the new customer. Okay, solving this equation, we get an IRR of 77%. So that's already quite high, right? And in 1.5 years, they are getting their money back. And from then on out, it's purely profit, and they are getting 77% return on it. And that's even without using the synthetic agents. So things will get a lot better from here. What happens if their marketing efficiency improves? Okay, that's the next equation. Basically, same thing, except now we use 300 here. So when you solve this, you get an internal rate of return of 108%. That's great, right? More than 100%. They're basically doubling what they are spending each year, even without using the synthetic agents. Okay, now let's have a look at what happens when they do use the synthetic agent program. The synthetic agent program stipulates that the synthetic agent is trying to get 16% internal rate of return, regardless of how much or what percentage of the customer acquisition cost they are paying. The IRR for the synthetic agent is always supposed to be 16%. Now, in theory, it could be lower if the customers churn too rapidly, but given our assumptions, this will not happen, and the synthetic agent will indeed get their 16% internal rate of return. And then you can ask, what kind of time frame do they need, right? What is the payback period for the synthetic agent? That would mean they are getting back their principal, so what they paid in customer acquisition cost, and the portion of the customer acquisition cost that is paid for by the synthetic agent, they have to get it back. Plus, they also want some interest. How much interest? Well, just enough, so they are getting 16% IRR. So that's a bit special in this type of loan that LMND is getting from the synthetic agent. It's not a loan over a fixed period of time. The loan can be short, it can be long. It automatically stops once the commissions that the synthetic agent has received total their initial principal and the interest that they need to get to 16% internal rate of return at that point in time. So that's a bit special, but that's how the deal is structured. Okay, so how long does that take? Well, let's have a look. So here we have an equation, and it's in fact a bit similar to the one we had in the beginning. We are again solving this equation for x, and x is here again the number of a month. We are trying to find out after how many months does the synthetic agent get their money back and the profit they need. So we are solving for x, and what we are assuming here is that the synthetic agent is paying for half of the customer acquisition cost. Now they can pay for up to 80%. Let's say they are paying for half, as they have done in the past quarters. Okay, well, let's see what happens then. If they are paying for half of the customer acquisition cost, then in return they will get 10% of the premiums of the customers that are acquired through this program. How does this work? Well, they can pay up to 80% of the customer acquisition cost, and if they are paying 80% of the customer acquisition cost, they will get 16% of the customer's premiums. That's their commission then. And if they are paying less of the customer acquisition cost, they will also get a lower commission. So here, for example, if they pay for 50% of the customer acquisition cost, they are getting 10% premium. So these are directly proportional, okay? So to get from 80% to 50%, it's the same change as to get from 16% to 10%. All right, so then here we have the premium that the customer is paying, monthly premium, etc. And here we are getting this 16% of IRR that the synthetic agent is supposed to get. Okay, so when you solve this equation, you get the number of the month after which the synthetic agent is paid back, including the interest that they are looking for. And when you solve this, it turns out you get a payback period of 56 months. Okay, 56 months, that's quite a long time, and it's actually longer than what Lemonade announced in their blog post. Again, that shouldn't surprise us, because back then they were using this number, their marketing efficiency at the time, and maybe their marketing efficiency today is still the same. I'm just calculating here this column just in case they are going for very rapid growth, and they also have to not only acquire the ideal customers, but only the good customers, and maybe also the mediocre customers. All right. So if this is the case, they would need 56 months to pay back the synthetic agent. We can do the same calculation for these two boxes here. So let's have a look. It looks very much the same, except we are now using 250 instead of 200. And once more, we will do this using 300 as the initial annual premium of the new customers. And what do we get? Well, we get 37 months and 28 months. So shorter periods of time, which shouldn't surprise us, because they are getting more premium. So the commission on this increased premium will also be higher. So the synthetic agent will be paid back faster. Okay, that's fine. So now you can say, okay, the synthetic agent is making a profit, right? 16% internal rate of return. Very good return, actually. So you might expect that Lemonade is now making a worse return than if they are spending it all, if they are acquiring the customers all by themselves, right? Seems logical, like you are splitting the profit between Lemonade and the synthetic agent, but it turns out that's actually not the case, because even though there's a commission going to the synthetic agent, so Lemonade is actually getting less money, they're also spending less money because the synthetic agent is paying for a lot of the customer acquisition cost. So if you look at the percentage of return they are getting, this might in fact be higher than what it was before. So we will soon calculate this value for these three scenarios, but first let's look at how much time does Lemonade need to get their money back, right? Before it was 23 months if they are not using the synthetic agent. How long does it take Lemonade now to get their portion of the customer acquisition spending back? All right, let's have a look. It's the next equation in line here. Here we go. So what can we see here? Lemonade is spending half of the customer acquisition costs, right? This is the total customer acquisition cost. This is the portion paid by the synthetic agent. So this is what is left over for Lemonade to pay. And then this is the money they are getting back from the customer, which includes their annual initial premium. It also takes into account the loss ratio, the annual dollar retention, and also now the commission that is being paid to the synthetic agent, right? And again, we are solving this equation for X, which is a number of a month. This is the payback period that is needed for Lemonade to get their money back. Okay, let's see how long it takes. 17 months. Okay, so here we can see a first clear benefit of using the synthetic agent program. Instead of 23 months, it now only takes them 17 months to get their money back, which of course is very beneficial. It's good for their cash flow. Okay, let's do the same here. It's basically the same equation, except we are using 250 instead of 200. Everything else remains the same. And it takes only 13 months to get their money back, down from 18 months. Okay. In the last column, for good marketing efficiency of 300 divided by 100, right? Then how long does this take? This is the equation. It's basically the same again. Only difference is we used 300 instead of 250, and it only takes them 11 months this time. So within a year, Lemonade is actually getting their money back, right? Which is quite fast actually. So that's a first thing to get excited about. The synthetic agent program lets Lemonade recuperate their customer acquisition spending much faster. Okay, that's one benefit. Now let's look at their internal rate of return. What's the internal rate of return for Lemonade? So on the money they are still spending themselves, how much return are they getting on this money. Now the equation is getting a bit more complicated, so let me walk you through it. First of all, we can see here what Lemonade is spending in marketing costs, right? This is the 50% that is being spent by the synthetic agent. That's just an assumption. It could be up to 80%. We will look at that scenario later. But for now, let's say the synthetic agent is spending 50% of the marketing costs. So 1 minus 50% is still 50%. That's what's left over for Lemonade to pay of the $100 customer acquisition cost. Okay, so that's what Lemonade is spending. Now let's look at what Lemonade is getting back. First, there's a period where Lemonade is getting some money from the customer, but they are also having to pay a commission to the synthetic agent. How long does this last? Well, we calculated it before, right? We calculated here that it takes 56 months for the synthetic agent to be paid back, right? So that's why here we are summing from 0 to 55, which is 56 months in total. And you can see here that there's a commission that is being paid by Lemonade to the synthetic agent. And after this month here, we will start the next month without the commission. Okay, the synthetic agent is paid back, the deal is closed, and from now on, these customers are getting or are paying to Lemonade, and Lemonade does not have to give any commission anymore to the synthetic agent, which is a big difference compared to traditional agents where the commission might last the lifetime of the customer, right? So they are basically paying for it in eternity. Now, not anymore. The synthetic agents, the commission stops after a certain amount of time. So we can go up to infinity. That's fine. The sum will converge after a reasonable amount of months. And then we are solving the equation for x here, which is their internal rate of return of Lemonade, also taking the value of money decreasing into account. Okay, so time value of money is accounted for. Let's have a look. What's the result here? What's the solution to this equation? And now it's time to get really excited. Let's have a look. It's 89%, right? What a clear benefit. Without using the synthetic agents, Lemonade's internal rate of return on their marketing spend is 51%, which is quite high already. But now, when using the synthetic agent, it bumps up to 89%. And this is in the case that the synthetic agent is paying for half of the marketing costs. So it's almost, well, it's not quite a double, but still it's quite a big increase, right? Let's have a look at what happens in this second column. What's the difference in the equation? Well, two things are changing. First of all, we have to change the initial premium that Lemonade is getting from the new customer, and we use that here. We also use that here. But secondly, we also have to change these sums here, right? You can see this sum only runs up to 36 now, from 0 to 36, because the payback period for the synthetic agent in this scenario is only 37 months. So we have to take that into account. The commission stops faster, right? Okay, so when you make these changes, so this one changes, this one has changed, this one has changed, and this one has changed, and you solve the equation again, then you can find the internal rate of return of Lemonade to be 137%. More than 100%, I think, well, that's just a magical number, right? But 130%, 137, excuse me, that's just an enormous rate of return, right? They are more than doubling their investment, basically, every year, as long as they keep doing this. That's a lot, but we still have a lot of boxes to go, so bear with me, because things will be getting even better. Okay, now let's look at this column. Remember, this marketing efficiency, that's the marketing efficiency they had 6 months ago. So maybe it will get worse if they go after more customers, but maybe it will remain the same. We don't know, we'll see. But still, it's important to have a look at this number. It might be a reasonable assumption, right? You can make up your own mind about that. Okay, so What do we change in the equation? Again, we change the same numbers as before. We change the initial premium of these new customers, all right? And then we also change these months, because in this scenario, the payback period has changed again. It's only 28 months now. So we sum from 0 up to 27 to get these 28 months. And what internal rate of return do we get then? Let's have a look. 199%. Isn't that amazing? 199% internal rate of return is Lemonade getting on their customer acquisition spend when the synthetic agent is paying for 50% of the marketing cost. That's just insane. Now, of course, you have to remember this is based on the assumptions that we are listed here above. So if you think these assumptions are wrong, of course, this result will also be wrong. But if you think these assumptions are reasonable, then this is what the math is telling us. Feel free to check my calculations. If you find anything wrong with them, let it know in the comments below. Okay, let's have a look at another scenario. What if Lemonade is using the synthetic agents even more? What if the synthetic agents are paying for 80% of the marketing cost? You can see here, we have 2 rows here that go through those numbers. And for the first 2 rows, well, you will see that these are actually the same as before. So I will make them visible all at once. Even though a synthetic agent is paying for a higher portion of the marketing spend, they are still aiming for the same internal rate of return. Now you have to make sure not to confuse this internal rate of return of 16% that the synthetic agent is going for no matter what with the 16% commission that the synthetic agent gets when they are paying for 80% of the marketing cost, right? So these two are different. It's both 16%, but it's not the same 16%, right? Regardless of how much of the marketing spend the synthetic agent is paying, they are trying to get a 16% internal rate of return. But if they are spending 80% of the customer acquisition cost, they will get 16% commissions from the customers. If they are spending only 50% of the customer acquisition cost, then they will be getting 10% commission. Okay? But even though they only get 10% commission, they will receive those commissions until they get 16% internal rate of return. Okay? So it's a bit confusing. Internal rate of return for the synthetic agent is always supposed to be 16%. And if they pay more of the customer acquisition spend, then they will get a higher commission to reach that 16% internal rate of return. Okay. Why are these payback periods the same? Well, that's a good question, even though I asked it myself, but maybe you thought of it. Well, if you look at the equations, so this is a payback period for the synthetic agent. And if you increase this to 80%, then you have to increase this to 16%. And you will see that basically it gives the same result. So the payback period for the synthetic agent remains unchanged. Okay. Right. Back to the next equation, which is the one for the time needed for Lemonade to get their money back when they are using 80% synthetic agents. Okay, so that's this equation here. 80% of the customer acquisition cost is spent by the synthetic agent. So 20% is left over for Lemonade. So this is what Lemonade is paying. And this is what they are getting back. And we are trying to find out after how many months do they get to zero, right? So after how many months are they getting their money back? You can see there's a commission going to the synthetic agent. There's also the loss ratio and the annual dollar retention. And we're also taking the time value of money into account again. And then you will see that the payback period for Lemonade has actually been reduced even further down to 9 months. Only 9 months now. Lemonade is spending less of the customer acquisition cost. They are giving a commission to the synthetic agent, but still in the end, it turns out Lemonade is getting their portion of the money back after only 9 months, right? So that's quite good. Now, the synthetic agent, they need 56 months to get the return they want, but after 9 months already, Lemonade itself is paid back. So that's great. Great for cash flow. Okay, let's have a look at the second column. What if their marketing efficiency is a bit better? Okay, we use the same equation again, except we change the 200 to 250. And then we find that they only need 7 months, right? 7 months to get their money back. Okay, that's not a long time. Then third one, this is the equation. It's the same as before, except we now use 300. And when you solve this equation, it turns out that Lemonade gets their money back in only 6 months. Half a year, and Lemonade gets their money back. So will Lemonade have cash flow problems? Make up your own mind, but if these assumptions are correct, I think they will get their customer acquisition spend back in 6 months. That's fast. That's very fast. Okay, now let's look at the internal rate of return Lemonade is getting when the synthetic agent is paying for 80% of the customer acquisition cost. Again, it's the same equations as before, so I won't go through them all again. Remember, if you change the values, don't only change the premium numbers, also change the number of months here, right? The payback period for the synthetic agent changes, but is basically the same equation that we used to calculate these three values here. So I won't go through them again. I will just reveal the result, right? So let's assume their marketing efficiency is going to drop in the coming year because they will be growing rapidly. They will be acquiring not only the ideal customers, but also the maybe less profitable customers. So maybe they are only getting $200 of new premium for every $100 in marketing spend. Okay, what will be their internal rate of return then? Let's see. 263%. 263%. That's amazing. It's just amazing. And it's maybe counterintuitive, right? If they don't use the synthetic agent program, they're only getting 51% return on their marketing spend. And if they do use the synthetic agent program, they're sort of splitting the profit, and still they're getting a return of 263%. So it's very counterintuitive, but the math doesn't lie. At least that's what I hope, right? That's what I trust. Please feel free to check my calculations. If you find something I did wrong, if I made a mistake somewhere, please let me know, because sometimes it sounds too good to be true. So let me know if it is. Second scenario, what if their marketing efficiency is a bit better? Okay, let's make it visible. 446%. Amazing, just amazing. And now, of course, I saved the best for last. What if they are still getting the same marketing efficiency they had 6 months ago, and they are using 80% of the synthetic agent? Synthetic agent is paying for 80% of the customer acquisition cost. Let's have a look. $733. 733%. 733%. Can you believe it? I don't know if I can. It really does seem too good to be true. But I think it might be true. We'll just have to wait and see. See you soon.